Good evening, everyone. My name is Andy Robertson, and I'll be your instructor for tonight's program, Making the Most of Social Security. Before I get started, I want to take a minute and introduce our hosts tonight. Bob Martin and Brian Tuttle are with Cape Cod Financial Services. They're the financial executives there with Cape Cod Financial Services. And Brian and Bob were kind enough to invite me to join you tonight and deliver this presentation, a presentation that means a lot to me as I'm the author, and we believe the content we have is incredibly important for those who are at or nearing retirement. Also want to point out that both Bob and Brian are uniquely qualified to help you with any of your Social Security planning needs, as both have successfully matriculated through the Certified in Social Security Claiming Strategies designation and routinely help folks make the best decision they can when it comes to their Social Security claiming strategy. So in addition to saying thank you to Bob and Brian for the invite and the opportunity to share the story, I also wanted to thank Mike Bourget with Athene for sponsoring tonight's event. They've done a great job, again, letting us get this message out to those who are at or near retirement. And we're certain that you'll find this message that they sponsored to be very compelling. Before we get started, I want to just take a minute and ask all of you who are in attendance to complete a simple poll. The poll is really designed to give me a clear understanding of what your expectations are about tonight. Take a minute and answer the simple question so that I can be sure that once we get going, I cover all of the things that are important to you. I'm going to leave that poll open here just for a minute and give you all a chance to respond, and then we'll begin the presentation. Okay, we'll leave that poll open for just another minute. We've got a good sized group tonight. I want to make sure everybody has a chance to get settled in and answer those poll questions before we begin the formal presentation. Okay, I'm going to close that poll. Thanks everyone for going through the process of answering that poll. And let me share my screen with you and begin the formal part of tonight's presentation. So this presentation, as you know, is titled Making the Most of Social Security. And in particular tonight, what we're going to focus our time and energy on over the next hour or so is the concept of Social Security optimization. So Social Security is a key tool in building fortified retirement income plans. And my goal tonight is to leave you far better off from a knowledge perspective around Social Security than you were prior to this webinar. Social Security optimization, again, is a concept, as you'll see, is a really unique opportunity to impact your retirement income plan right before you finalize everything, because Social Security is something that you actually address right at the time you're ready to retire. So Social Security optimization is really all about addressing what essentially is the biggest concern that we know people have about retirement in 2020. And I think John Ziden, a financial advisor, captured it perfectly when he said the fear of dying has been replaced by the fear of living too long. This is truly, what people are up against in 2020. And what we want to look at is how can Social Security ultimately, as a planning tool, help you address this fear. And before we do that, we're going to just take a couple of minutes and go through what I describe as Social Security basics so that I know we're all on the same page as it relates to the inner workings of Social Security. And then we can talk about some of the more interesting concepts that we have to share tonight. But to start out, I just want to remind you that when it comes to Social Security, what we're talking about here is the Old Age Survivor and Disability Insurance Program, created as part of the Social Security Act in 1935 and originally designed to keep the elderly and the sick out of poverty. No one imagined at the time it was created that by 2020 would be the primary income source for some 70 plus million baby boomers. But that's where we are today. And again, it's a critical piece of an overall healthy retirement income plan. Now, in order to actually access the Social Security retirement system, you have to be what's known as fully insured. And to be fully insured, you have to have accumulated 40 credits. Most folks talk about 40 quarters. The soonest you can earn 40 credits is in 40 quarters, because you earn a credit each time one of your quarterly earnings surpasses the quarterly earnings requirement of Social Security. So once you have 40 credits, the soonest you can do that is 10 years. You are considered fully insured. And once you are fully insured, you have several options, but the three we're going to talk about today are the ability to tap into benefits early, the ability to wait till full retirement age, and then ultimately to delay, and what the value of delaying might be. So first and foremost, let's talk about full retirement age. Full retirement age for many of you is going to be around 66, certainly somewhere between 66 and 67 for everyone on this call. If you opt to take benefits before attaining full retirement age, you can do so. You can do so as early as 62, but if you do, as I'm sure most of you know, there's a penalty in essence that you suffer as a result of taking early, and that is through a reduction in your benefit value. So if you have a full retirement age of 66 and you opt to take retirement income benefits as early as possible, 62, you're going to incur a 25% reduction in your monthly benefit rate. And that reduction is for life. You're not going to ever recover from that. So it's a big decision, obviously, when is the right time to take benefits. And there are a lot of factors that you have to consider when you're making that decision. But obviously, a 25% reduction is significant. Of course, you don't have to take benefits at 62. You can wait and take benefits at full retirement age, or you can delay. You wouldn't want to delay beyond age 70, but if you did delay, there'd be real value there for you to earn in return for doing so. Now, as it relates to full retirement age, I just want to be clear that for most folks, full retirement age is going to be somewhere between 66, again, and 67, dependent upon your year of birth. So if you were born prior to 1954 and after 1943, full retirement age is 66. If you were born after 1954, for every year after, we had 2 months. So if you were born in 55, it's 66 and 2 months. If you were born in 56, then your full retirement age is 66 and 4 months, and so on until we reach 1960 or later. Full retirement age for this demographic is age 67. Now, if you opt not to take benefits early, not to take benefits at full retirement age, and you delay taking benefits, you're rewarded via what's known as delayed retirement credits. Now, if you were born after 1943, which I'm guessing most folks here were, the value of delaying is Social Security will reward you with what's known as delayed retirement credits, equivalent to 8% per year. This 8%, for what it's worth, is a simple interest application, not a compounded application. And that's frankly because Social Security will not apply the delayed retirement credits until you actually file for benefits. So there's no opportunity for compounding, simply because the delayed retirement credit isn't applied until you take benefits, which could be any time between 66 or full retirement age and 70. Now, to give you some perspective on how this might play out from a benefit calculation perspective, let's say we have somebody with a primary insurance amount of $1,000. So your primary insurance amount, to be clear, is your retirement income benefit at full retirement age, which we'll assume for our examples today, full retirement age is 66. So your primary insurance amount, or PIA, is your retirement income benefit, or RIB, at FRA. And if you opt to take benefits early, of course, the earliest you can take income benefits is 62, then you'd have a 25% reduction, which means instead of receiving $1,000 a month, you'd be entitled to $750 a month. Of course, again, you don't have to do that, and you can wait. And the longer you wait, obviously, the more you receive of your primary insurance amount. And then in addition to that, if you continue to delay and not take benefits at 67 or 68 or 69 or 70, then you're entitled to these delayed retirement credits, which are applied when you file to take benefits. So if you waited until 70 with an FRA of 66, you'd get 32% more at 70 than you would have received at 66. So your $1,000 would actually be $1,320 a month because you delayed, and those 32% or 8% per year of delayed retirement credits are then applied once you reach age 70 and file and take benefits. A lot of people are crystal clear on the idea that they're going to incur a reduction if they take early, or they're going to be rewarded if they take benefits late. What a lot of people don't know is the difference between what you receive at 62 and what you receive at 70 is 76%. So let me be clear. If you have a full retirement age of 66 and you're thinking about taking benefits at 62, I can tell you unequivocally, under current Social Security formulas, if you choose not to take benefits at 62 and wait all the way till 70, you're going to get at least 76% more at 70 than you would have received at 62. And that's an important thing to understand, because later, when we talk about a concept called break-even, we're really going to address and analyze what it takes for a break-even type approach to match the economic value of waiting. And we're going to do that because we think it's an important additional consideration you need to give before ultimately deciding what you want to do. Now, before we get into all of that, I just want to take a minute and talk about one other Social Security basic that's critical from our perspective when it comes to retirement income planning, and that is the idea of a spousal benefit. So one of the things that creates an opportunity for potential, what we'll call Social Security planning and Social Security optimization, is the existence of something known as a spousal benefit. And what a spousal benefit allows one to do is, if we have a situation where we have two spouses, one of the spouses may see an increase in their benefit as a result of the benefit rate of their spouse. So let's kind of talk about how this works. And I'm gonna jump ahead just to make this a little easier. To determine whether or not you're entitled to a spousal benefit, the Social Security Administration really does something very simple from an analysis perspective. The first thing they do is they take the higher of the two Social Security benefits and they divide it by 2. And they compare that half a benefit to 100% of the other spouse's PIA benefit. So it's a half a benefit compared to the whole benefit. So a half of the larger benefit compared to all of the lower benefit. And if the lower benefit is worth less than half of the higher benefit, the difference is going to be applied to the lower benefit in what's known as an excess spousal benefit. And that spouse with the lower benefit will actually receive at least 50% of the higher benefit value. So let's look at numbers to kind of demonstrate this a little more effectively. Let's say we have a husband and wife with a PIA for him of $2,400 and a spouse of $1,000. Now, this happens to be, we created this case study, and this happens to be very similar to what's happening in my house, because my wife was out of the workforce for a long time, raising 6 kids. So while she's fully insured, her PIA calculation is not as high as mine because of the time out of the workforce. So as we look at this, we look at a $2,400 PIA as the higher of the two PIAs and a smaller PIA of $1,000. Well, if we follow the process that the Social Security Administration goes through, we take the higher of the two PIAs, the $2,400, and divide it by 2. It's $1,200. And we compare that to 100% of the lower PIA, which is $1,000. And we determine that in this case, the spouse is entitled to what we call an extra or excess spousal benefit equal to $200. So what does that mean? What that means is at full retirement age, if they both file, in this case, he's going to receive $2,400 from his earnings record, and she's going to receive $1,000 from her earnings record and an additional $200 in an excess spousal benefit for a total of $1,200. So he's going to receive, in this example, $2,400 a month, and she's going to receive $1,200 a month. And as a household, they're going to receive $3,600 a month. So there's a rule of thumb here that you can take away, and that is that any household is going to have a total income value from Social Security equivalent to at least 150% of the higher of the two benefits. At least 150% of the higher of the two benefits. And the reason I say that is, let's say the wife's PIA was $2,000 and his was $2,400. Well, we take half of $2,400, $1,200, and compare it to $2,000. There is no need for an excess, right? So that was the minimum. This is going to be more because her PIA is $2,000. But the other part of this that's critical to understand is, let's say one of the spouses isn't fully insured. They didn't have 40 quarters. They didn't achieve 40 credits, earn 40 credits. So this number is a zero. So let's say the PIA for the lower earning spouse is a zero. The same process is followed. And now in this case, the spouse with the zero is still going to receive $1,200 in a spousal benefit. So again, every household is entitled to at least 150% of the higher of the two benefits. Cannot be less, could be more depending on the value of the lower benefit as compared to 50% of the higher benefit. So a lot of opportunity there, and you want to make sure that you're able to take advantage of that. There are circumstances where some folks can still collect a half a benefit from their spouse while their benefit continues to grow and earn DRCs. You want to make sure you explore that before you make any decisions. The other thing we want to talk about from a spousal benefit perspective is something called an independently entitled divorced spouse. So not only can married spouses collect a spousal benefit from their spouse, but so can divorced spouses, so long as they meet the criteria of being independently entitled. That criteria is pretty straightforward. They have to have been married for 10 and divorced for 2. They're at least 62 now. They're not currently married. And their PIA is worth less than half of their former spouse's PIA, just like we saw in the math a moment ago. And the only other consideration is their former spouse must also be entitled, which is really just a fancy way of saying the other spouse must also be at least 62 as well. Now, couple of things to point out. To establish the timeline, 10 years, married for 10 and divorced for 2, the Social Security Administration requires that you bring to them a marriage certificate and a divorce decree or some other kind of legal document that establishes these timelines. But as long as you have that documentation and you know your former spouse's Social Security number, you can access a spousal benefit from your former spouse if you're independently entitled, and they don't even know about it. And you don't need any other information. So it doesn't impact them and it doesn't impact their benefit. It can only help you, and they're completely unaware that this is even happening. So real opportunities for spousal benefit planning, regardless if you're married or you're independently entitled. The other piece for an independently entitled divorced spouse, as well as somebody who's married, is a survivor benefit. So once one of you passes away, you have the opportunity to collect the survivor benefit. And there are critical planning opportunities in those situations where one spouse, the surviving spouse, can collect one of the benefits while the other benefit continues to grow. And we often see situations where people are unaware that they could be doing that, and they take the wrong benefit first, and they miss out on significant upside for the other benefits. So when it comes to survivor benefits, two things. You're dealing with a whole benefit, not a half a benefit. You have the ability to collect 100% of your deceased spouse's benefit. And at the same time, you may be able to collect their benefit while your benefit continues to grow via delayed retirement credit. So you certainly want to explore that and make sure that you're extracting the most that you can from Social Security, because that ultimately puts less pressure on the capital that you've saved for retirement. Now, the only caveat here is, from an independently entitled divorce perspective, is you have to be married for 10, divorced for 2, but you can actually remarry and still meet the criteria as an independently entitled divorced spouse, so long as you didn't remarry prior to age 60. So from a survivor benefit perspective, you can be married for 10, divorced for 2, and you can actually be remarried, but not remarried prior to age 60. The only other caveat here is, for a spousal benefit, which is a living benefit, you have to be at least 62. To collect the survivor benefit, you can collect a survivor benefit as early as 60 or 50 if you're disabled. So again, when it comes to planning within the Social Security retirement system, you certainly want to be aware of your options within the survivor benefit scenarios, whether you were married at the time your spouse passed away or you were independently entitled. By the way, if somebody were considered independently entitled and remarried after age 60 and subsequently had lost both their former spouse and their current spouse, they actually can collect a survivor benefit from either one of those spouses, and you make the determination based upon which survivor benefit is going to be more fruitful for you. So there's some very interesting planning opportunities within the Social Security retirement system on the survivor side as well. Now, one of the things that I want to talk about is this concept of break even. the vast majority of those who are currently collecting Social Security benefits opted to take benefits early. And when I say early, what I mean is most are taking benefits prior to full retirement age, as you see here. Many are taking benefits or have historically taken benefits as early as age 62. What our research indicates is that many of the people who take benefits at 62 do so because they're concerned about a couple of things. One, they may not be here at 70, so they're afraid to wait until 70, or they're afraid Social Security may not be here if they wait until 70. And there are a couple of things that I would say in response to that. The first thing I would say is when it comes to planning, our objective is to make sure that you never find yourself in a position where you're out of money, where you never go broke. Our goal is not to make sure that you break even. Secondarily, when it comes to retirement income planning, I'm willing to bet that for most of us, we can't actually have a productive and meaningful planning discussion if we assume Social Security won't be here. Social Security is the primary income source for an entire generation of people. Pulling the rug out from under those people and the consumption power that Social Security income represents is just not an option. In 2008, we learned that certain financial institutions were systemically too big to fail, that we couldn't withstand a failure in our economic system, so we held them up. Well, Social Security, again, is the primary income source for some 70 plus million boomers, is the epitome of too big to fail. And as a result, it's very much worthwhile to look beyond what everybody else is doing and see what other things you should consider before you make your final decision. Now, when it comes to taking benefits early and this concept of break even, what I normally see is people who say, I'm going to take benefits at 62, but I'm going to keep working. I'm going to take that income I get from Social Security, I'm going to invest it, and I'm going to grow it, and I'm going to create a secondary retirement account that if I am still here at 70, can match the increase I would have received automatically from Social Security had I not taken benefits at 62 and actually waited till 70. And while that may sound good in theory, there are a couple of challenges you're going to have to overcome if that's your thought process. The first of which is known as the earnings test. So what the earnings test says is if you're collecting Social Security benefits prior to full retirement age and you have earned income from gainful employment, you're going to be subjected to the earnings test. And in 2020, what that means is if you earn more than $18,240, for every $2 you're over that number, you're going to be forced to forfeit $1 in Social Security benefits. So let's look at a simple example of how this would play out. Let's say we have somebody who's contemplating exactly what I'm talking about. They're going to take benefits, but they want to keep working. They're going to grow those benefits through a secondary investment account, secondary retirement account. They're going to save all that income, and they're going to build a secondary pile of cash that matches, or hopefully could match, what Social Security would provide at 70. Okay, again, sounds good in theory, but here's the first challenge. Let's say you go out and you take benefits while still earning $60,000. Well, if we look at the earnings test threshold, $18,240, this person would be over the threshold by $41,760. Now remember, for every $2 you're over, you forfeit $1 in benefits. So if we divide $41,760 by 2, your forfeiture requirement is $20,880. Now let me be clear. I use that term forfeiture. It's a strong term, but I do that for a reason, because this is exactly what happens. Social Security does not issue partial checks. If you're required to face the earnings test, and as a result, like in this situation, you're required to forfeit $20,880, what's going to happen in that year is they're going to withhold every Social Security check you otherwise would have been entitled to receive until the amount of money they've withheld matches this $20,880 forfeiture requirement. So simply put, if you were in a position to earn $20,880 in Social Security benefits beginning at 62, but you kept working and earned $60,000, you'd forfeit the entire year's worth of checks. And if you attained age 62 on January 1st and you attained age FRA, full retirement age, 4 years later, you would have forfeited your entire $20,880 a year for 4 years, or $83,520. So this idea that I'm going to take benefits early, I'm going to keep working, I'm going to invest and grow a secondary pile of cash by saving the Social Security income I'm collecting but I don't need, it's not going to work out because you're never going to get your hands on those checks. So in this example, you'd go 4 years never having received a check. So this idea that I'm going to build a secondary retirement savings account is a real challenge when you don't get your hands on the money. So that's the first thing when it comes to understanding the challenges. The second thing is, what other challenges does Social Security address from a planning perspective? So right now, some of the biggest obstacles we face in the planning process are building retirement income plans that are designed to address the longevity issues, retirement of 25 or 30 years, the taxes that not only are you faced with paying now, but what are the odds taxes are going to go up over the next 25 or 30 years, regardless of kind of where your political affiliations lie. I think we can all agree, given where we are fiscally as a nation, it's highly likely that we'll see a tax increase, even for those in retirement. I know there's been countless articles written in financial publications indicating that most people are in a lower tax bracket when they retire. I'm not really sure how it is they came about that conclusion. I've never been able to find a retirement tax bracket. How much you pay in taxes in retirement is predicated on the same tax code that you had to deal with while you were working. So I'm not really sure where that assumption comes from. But more importantly, again, I think taxes are part of a long-term fiscal solution, and we've got to be prepared to navigate around that from a planning perspective. And lastly, inflation. I mean, most of you can understand something as simple as, it costs more today potentially for a car than what it costs for your first home. And that's the impact of inflation over time. So if you're looking at a 25 or 30 year retirement, not only are you combating the timeline, but you're combating the impact of taxes and inflation. And a lot of this issue, I shouldn't say this issue, but a lot of the challenge is placed upon your retirement savings. And what we want to explore is, how can Social Security are transitioning more of the income burden in the face of longevity, taxes, and inflation over time? How can that impact the outcome of your plan and improve the likelihood that your plan is successful and that you actually preserve some of your retirement savings rather than wake up penniless? And in order to truly understand that, or understand just the scope of the challenge, it's worth talking about some of the research that's out there. And I'm sure you've all seen similar kind of conclusions like the one I'm going to talk about now. I feel like a day doesn't go by where we don't hear something like this. But the National Institute on Retirement Security published their research findings in 2008 on essentially Americans' preparedness around retirement income planning. What they discovered, based upon their research, is that 77% of working households are not on pace to meet their retirement savings targets. Or put another way, 77% of American households are going to be underfunded. So when they arrive on the doorstep of retirement, what they've saved and what their plan actually needs are two different things. And the vast majority, some 77%, are going to be in a position where they don't have enough money to maintain their lifestyle in retirement. So they're going to have to think about a different strategy. Those different strategies could include maybe delaying retirement, maybe continuing to contribute to retirement income plans while you delay retirement and grow your savings, maybe reducing the amount of income and the lifestyle that you were hoping for in retirement. But what we want to tell you is, while that's the case, based upon their research work, what we've found is all of these research projects look at Social Security one way. They assume everybody takes benefits early. So in the research that they do, they never take into consideration the role Social Security could play in changing this outcome simply by having people looking at taking benefits at different times. And that's what we're focused on when it comes to Social Security optimization. We can't put you in a position at 65 where we can double your retirement savings when you're on the doorstep of retirement, but we can certainly look at the Social Security strategy you're employing and ask, could a different strategy change this outcome? Could a different strategy put you on the winning side of this equation? Could it mean that you're one of the 23% of the population that goes from underfunded to fully funded? or maybe fully funded to overfunded. And that's our goal with Social Security optimization, and why we fixate on Social Security as this ultimate retirement rescue opportunity is because for most of you, Social Security is the only form of retirement income that you have at your disposal that looks like this. It's paid for life. It's continued for the life of the surviving spouse. And I want to be clear that the higher of the two benefits is continued for the life of the surviving spouse. The income is automatically inflation adjusted. And we're going to spend a couple of minutes on that because that's an important point to talk about. It's highly tax efficient. You'll see as when we're through, there aren't many sources of income in retirement that you're going to find that are more tax efficient than Social Security. Many have no idea that this is the reality. And lastly, unlike some of those financial institutions that we discovered in 2008 were too big to fail, Social Security is backed by a government promise. So this is why we focus on Social Security as kind of the foundational tool to building better, more fortified retirement income plans, because nothing else in the toolbox looks anything like what we see here with Social Security. Now, to truly appreciate the economic value of Social Security in the retirement planning process, the first thing we need to do is address what it would take to match that 76% increase you're guaranteed at 70 if you wait to take benefits at 70 rather than 62. So again, I know many people, what they consider doing is, instead of waiting, taking benefits early, saving that money, they continue working, and their goal on paper is to build the secondary retirement account that'll more than match or make up for what they would have gotten had they waited to take Social Security. And again, you saw firsthand that there are a number of challenges, the first of which is the earnings test. But the other thing I want to talk about is how challenging is it and how likely is it that even if you took benefits early and you didn't get exposed to the earnings test, that you could actually build a secondary retirement account that would be big enough to match the guaranteed increase provided by Social Security at age 70. And let me be clear, I don't want your takeaway from this presentation to be everyone should wait till 70. I'm just trying to show you the two extremes. Somewhere in the middle is the optimal strategy for you, and it's based upon a whole host of things. Number one, are you married? Are you divorced? Are you widowed? Number two, what's the disparity in age if you're married? Do you have two benefits coming into the household or one? There are all kinds of factors that play into this. But for tonight's presentation, to keep it simple, I'm focusing on the two extremes, taking as early as possible or waiting until 70. And by the way, you wouldn't want to wait beyond 70 because you don't earn anything beyond age 70 in delayed retirement credits for waiting. So you do not want to wait beyond 70. But let's look at a simple example. Let's say we have a husband and wife. His PIA is $2,650 and hers is $2,000. And they're thinking about, instead of waiting to take benefits at 66 and collecting $46.50 a month together, they're going to take benefits early at 62. And because of the 25% reduction they incur for taking early, instead of getting $46.50, they're going to get $34.88. But the plan is we'll take that $34.88 that we're going to get every month over the next 8 years. We'll invest it like clockwork, and we'll build a secondary pile of cash. So if we're still here at 70, the secondary pile of retirement savings will match what the increase would have been had we waited to take Social Security. Okay, well, what would it take to do that? How much money would you have to save? Well, the first thing you have to do is identify what's the increase. So again, it's 76% more at 70 than it is at 62, or 61.39. So that's $26.51 more per month at 70 than you would have gotten at 62. And that's the minimum increase. It cannot be less, but it could be more. We'll talk about that in a minute. So the question is, if I took my benefits at 62 and saved them, it's $34.88 a month like clockwork, how much would I have to have by the time I reach 70 to match this increase that I would have automatically been guaranteed? The $26.51 per month, or if we look at it annually, $31,812 per year. And what we do to answer that question is we visit some very credible research that's been done here over the last 30 years on the concept of retirement income planning. And that research is called Safe Withdrawal Rate Research. And what you'll find if you look at it for yourself is that in 1992, there was a study published by the name of the Bengen study that told us that the safe max that you can take every year and not have an 80% probability that you will not run out of money over the next 25 or 30 years is 4%. So the 4% safe max rule is a rule that is commonly heard of in retirement planning circles and by those who are on the verge of retiring. A couple of things about this 4% safe max number that's widely discussed. First is that's a gross number. So meaning if you're investing your money, whether it's at Vanguard or you're working with a full service financial advisory firm, there's going to be a cost. That has to come out of the 4%. You keep the difference. The other piece of this that's critical to understand is that 4% safe withdrawal rate number, that safe withdrawal rate max number, assumes that you're okay with an 80% probability of success. Now, our research indicates that the vast majority of people prefer a 90% or better probability of success. So what we're going to do is we're going to take this increase that you would have been guaranteed from Social Security had you waited to take benefits early and determine how much you'll have to save between 62 if you actually take the benefits at 62 to deliver the additional $31,812 that Social Security would have guaranteed you. And the way we're going to go about doing that is we're going to take that safe withdrawal rate research. We're going to ratchet up the probability of success number that we're looking for to 90%, which is fair because the probability that you're going to see the increase at 70 from Social Security than what you would have received at 62, obviously is, we're assuming 100% today. So if we ratchet up the probability of success number from 80% to 90%, the safe max rate goes from 4 to 3.4. And then we assume 1% or 100 basis points in fees. That leaves 2%, 2.4%. That's the withdrawal rate that the investor would net. So the question is, if I want to match the $31,812 that Social Security is guaranteeing me of additional income I'd get at 70, and I take benefits at 62, I get that 3488, and I want to match the 31812. I save that 3488 every month like clockwork. How much money do I need to have at 70 to deliver this 31812 at a safe withdrawal rate of 2.4%? And the answer is $1,325,500. So here's the point. It sounds good in theory that I'm going to take benefits early. I'm going to invest them. I'm going to grow them. I'm going to put myself in a position where at 70, if I'm still here, I can match what Social Security would have provided. Well, it sounds good, but to accumulate $1,325,500 by the time you're 70 at a savings rate of $3,488 a month beginning at 62, you have to earn 19% or nearly 19% each and every year like clockwork to do that. And if you did receive that kind of a return, which is unheard of over any 8-year period, all you would have succeeded in doing is matching the increase that Social Security was guaranteeing you at 62 if you waited until 70. So I understand why people look at break even initially, but when you start to look at these numbers, you take a step back and say, yeah, that's a real challenge. I don't know that I'm going to do that. I don't know that I'm going to be successful in doing that. And the reality is, I don't care who you are, for the vast majority of the people that we meet, financial insecurity doesn't take hold at 65 or 62 or 70 or even 75. The real issues around financial income or income security in retirement start to creep in around 80, and they become exacerbated at 85 when both of you or one of you are still here and no one planned for that. So our job when we talk about retirement income planning is to get you to look 25 or 30 years down the road, not 8 years down the road from 62 to 70, because that's not when the issues are going to happen. The issues are going to happen 25 or 30 years from now, and to do anything different is not an option at that point. It's too late. The decisions we make today will determine our fate 25 or 30 years from now. That's why it's critical that you have this information. Now, one other thing on this topic. So not only are you guaranteed 76% more at 70 versus 62, but once you reach that first year of eligibility, 62, whether you elect to take benefits or not, if a cost of living adjustment is declared, your Social Security benefit is affected accordingly. Okay, so the media has done a tremendous disservice to all of us by beating up the ability of Social Security to combat the impact of inflation. The media says the consumer price index that the cost of living adjustment within Social Security is tied to is not favorable enough. Well, take a step back for a minute. Let's look at this through the proper lens and in the proper context. For many of you, Social Security may be the only form of guaranteed income you have. Never mind the fact that it's the only form of guaranteed income you'll find more often than not that it's automatically inflation adjusted. So imagine that we're questioning the validity of Social Security as an inflation fighter when it's the only form of income we have that the cost of living adjustment is automatic. And what has it been historically since 1975? 3.68%. So the question you have to ask yourself is, if that cost of living adjustment wasn't being applied to my Social Security benefit by Social Security, where would that additional income that the cost of living adjustment provides have to come from in order for me to maintain my purchasing power in the face of inflation? Well, it would have to come out of your capital. But in this case, for every dollar of additional income that you receive from Social Security as a result of a cost of living adjustment automatically provided by Social Security, that's $1 less that has to come out of your retirement savings, and another step towards preserving the long-term viability of your retirement capital. Now, again, if you turn 62 and you opt not to take benefits, every year that you opt not to take benefits, if a cost of living adjustment is declared, your primary insurance amount is favorably impacted. So let me show you what I mean. Again, I told you earlier at 62, if you have an FRA of 66, at 62, I can tell you unequivocally you're going to get at least 76% more. What I didn't tell you, but I'll tell you now, is whether you're taking benefits or not, if a COLA is declared, it's going to be applied to your primary insurance amount, and your primary insurance amount is going to grow on a compounded basis as a result of those cost of living adjustments, again, even though you're not collecting. And then finally, when you take benefits at 70, now you're going to earn that 32% in delayed retirement credits. And those 32% in delayed retirement credits are going to be stacked on top of your cost of living adjusted primary insurance amount. So what would that mean? If you attained age 62 on January 1st of 2011 and you didn't take benefits and you waited until 70, I would have been telling you on January 1st of 2011, you're going to get at least 76% more. Will not be less. But if any COLAs are declared, it'll be more. Well, how much more? Not 76%, but 104%. Why is that important? If we had to earn 19% on our money, if we took benefits at 62 and saved every penny for 8 years, and we had to earn 19% to match a 76% increase, then that wasn't attainable. What are the chances we're going to earn enough to match a 104% increase? And the other piece of this that's critical is this is going to impact potentially both benefits. And now the surviving spouse is going to be left with the higher of the two benefits, and that benefit is going to be 104% of what it would have been had you taken benefits at 62. Think about the implications to the surviving spouse, and how important is that? According to the Society of Actuaries, a wife outlives her husband on average by 14 years. So it's a big deal, and it's going to have a tremendous impact, a favorable impact on the surviving spouse. Now, let me bring this all together via a case study. So let's say we have a couple. They're both age 66, and their goal is to take benefits. They can't decide. Maybe it's 66 or later. But they're going to retire at 66. Their annual income goal, retirement income goal, is $85,000. And between the two of them, they've accumulated $800,000 in retirement savings. And what they're looking at is, how much capital do we need in order for us to have a successful retirement plan if we take benefits at 66 versus some other time? And we're going to focus on 66 because if you're like most of the people that we meet, you were thinking about taking benefits early and continuing to work, and now you know that's not an option. And in this scenario, we're assuming the same thing. So we're looking at 66 when the earnings test goes away, or 70. And we'll call the first scenario the earlies and the second scenario the laters. But to determine how much capital we need for the plan to be successful, the earliest plan of taking benefits at 66, what we do is we take the total Social Security income, $46.50 a month for the household, or $55.8 per year, and we'll subtract it from the income goal of $85,000. And that'll give us what's known as the income gap. And the question is $800,000 enough to successfully close that gap for the next 30 years with a 90% probability of success? That's our test. That's our goal. Conversely, what happens if we wait until 70? We're going to get 32% more from Social Security, at least. Could be more, can't be less. Again, why 32%? Because the difference between FRA and 70 is 32. The difference between 62 and 70 is 76. But because we're comparing FRA and 70, we're talking in terms of 32% now. So they're going to get 73,688 from Social Security at 70, and their gap's going to be less. Okay. But let's focus on the earliest for a minute. Their gap is 29.2. So if they retire at 66 and take benefits at 66, Social Security is going to provide 55.8, and they're going to need their $800,000 to deliver $29,200 to get them to the $85,000 goal. The latest gap would be $11,312, but we've got to consider inflation, a couple other things. We'll come back to that. Let's focus for a minute here on the earlies. So we call this a stress test. We look at this scenario and say, they have $800,000. They take benefits at 66. There's a gap of 29.2. Using that same credible science we used earlier, the safe withdrawal rate science, we know the net safe withdrawal rate, if we want income for 30 years and we want a 90% probability of success, we know it's 2.4%. So to determine how much capital we need in order to achieve that 90% probability of success over 30 years, we simply divide 29.2 by the 2.4% net safe withdrawal rate. And that tells us how much capital we need. What it's saying essentially is 29.2 is 2.4% of this number, $1,216,667. So what you're hearing is, if they want to move forward with this plan and they want to achieve a 90% probability of success over the next 30 years, this is how much they need, $1,216,000. Do they have $1,216,000? No, they have $800,000. Seems like they did a decent job saving for retirement. $800,000 is not a small amount of money. How far off the mark are they? They need 50% more than they have. And when you see this kind of approach to stress testing a plan, you can understand how these research outlets come up with numbers like 77% of Americans are underfunded. And it's true if you assume everybody takes benefits at full retirement age. What we're going to look at next, we're going to say, okay, well, that doesn't work. We're certainly not achieving a 90% probability of success. In fact, what we're probably going to achieve if we move forward with this plan is about a 50% probability of success, because we need 50% more capital than we actually have. We need 1.2 and we only have 800,000. So what are the alternatives? You can not retire, you can keep working, you can save more money, you can trim back your retirement lifestyle, or you can look at Social Security optimization. In this case, the Social Security optimization strategy we would consider would be not taking benefits at 66, but instead waiting to take benefits until 70 and taking advantage of those delayed retirement credits. What would that do? Well, that would do two things. Because of the additional income that we receive from Social Security, the gap would now fall to, it was $11,312, but we've got to inflate it because they're still retiring at 66. We've got to inflate it for 66, 67, 68, and 69. Now we're at 70. Here we are. It's now on an inflation-adjusted basis, $12,522. So the gap is smaller because Social Security is larger, and the safe withdrawal rate is also higher because we're 4 years into the 30-year time horizon. Remember, they're still retiring at 66. The question we're exploring is, when should they take benefits, not when should they retire. They're two different things in the later's example. So we're 4 years into the 30-year plan. We only need the $12,422 for another 26 years to achieve our 30-year goal. And we need $460,368 to achieve a 90% probability of success objective and threshold. Now, a couple more things. If they're still retiring at 66, the laters that is, and they're not collecting benefits until 70, how do they live from 66 until 70? Well, we're going to self-fund that $85,000 income need. We're going to increase it by 2.5% per year to account for inflation. And after 4 years, they're going to have used $352,964 to provide their income need during what we call the bridge period, which is the time between when they retire and when they take benefits. And we call that bridge capital. So they need almost $353,000 bridge capital. We add that to the $460 they need from 70 and beyond to close that $12,522 gap. And the total capital requirement is $813,000. So let me be clear about a couple of things here. What you just saw. So we took the same income goal, the same timeline, the same inflation assumption, the same probability of success, same income goal, same assets. The only difference between the earlies and the laters is when and how they elected to take Social Security benefits. And the outcome is they went from needing $1.2 million to be successful in achieving a 90% probability of success, which they cannot do because they only have $800,000, to being almost fully funded, needing $813,000. They need $813,332 to achieve a 90% probability of success, going about it the second way, and they have $800,000. I would argue they're fully funded versus being woefully underfunded and having about a 50% probability of success. They go to effectively fully funded and a 90% probability of success. And the primary and fundamental difference that caused this profound change was when and how they elected to take Social Security benefits. So it's critical that before you do anything, you look at the implications of Social Security on the probability of your plan's success. And again, Bob and Brian can help you do that through the software that we make available to them. But before I get into that, let me summarize kind of where we are. So if they retire at 66, by the time they're both 70, the inflation adjusted income is no longer $85,000. It's now $93,824. So you can see that here. And then the earlies are getting this much from Social Security. The laters are getting 32% more. Now the gap for the earlies was 29.2 originally. Now it's 32,231 because of inflation over that 4-year period. We're assuming the gap is being funded out of distributions from that $800,000 in retirement accounts, and that's fully taxable in our case study. The laters, their gap again is $12,522, again being funded out of their retirement capital and being considered fully taxable. Now, here's the added kind of attraction to Social Security optimization. Social Security is arguably the most tax efficient form of income you will find in retirement. There are certainly other things like Roth IRAs that look like they could be very tax efficient, but the reality is for most of us, Roth IRAs came along too late for them to have a real material impact on the overall tax efficiency of the plan. The dollar I take out of a Roth might be income tax free, but if my other $99 are fully taxable, the impact is negligible. Not the case for Social Security. Social Security falls under what's known as provisional income, and I'm going to close out the meeting by talking about that. But here's what I want you to know. Not only did we drive down the capital amount that they need in order for this plan to achieve a 90% probability of success, but look at this. The taxable amount of the $61,593 of Social Security income for the earlies is $22,173. We add that to the fully taxable IRA distribution, and on $94,000 roughly, there's $54,000 of taxable income. Most people are surprised by that. That's what by anybody's standards, tax efficient. What about the laters? Well, even though they have 32% more from Social Security, because of the tax efficiencies afforded and tax advantages afforded Social Security, only $13,797 of that is taxable. Add that to the $12,522 fully taxable gap we're filling with an IRA distribution, and the total taxable income for the laters is $26,319. So let me be clear. Not only did we deliver the plan for roughly $400,000 less in a capital requirement, but it's far more tax efficient. We've got 32% more guaranteed income and 52% less taxable income because of the advantages Social Security is afforded under provisional income. Now, that probably stands in stark contrast to what many know or think they know about the taxation of Social Security. So Social Security falls under the provisional income formula. What most believe is that if their Social Security benefit is over, as a married couple filing jointly, if their Social Security benefit is over $32,000 as a married couple, then 50% of their benefit is taxed. And if it's over $44,000, then 85% of their benefit is taxed. And that's just simply not how it works. That's an oversimplification of an otherwise complex tax advantaged opportunity. Here's how it really works. Social Security falls under the provisional income formula, and to determine how much your Social Security benefit is taxed, the IRS requires that you first determine what somebody's provisional income value is. So to determine their provisional income value, we take 100% of their modified adjusted gross income. So modified adjusted gross income is simply all your earned and unearned income. So that would be income from pensions, income from real estate investments, income from IRAs. That's all considered unearned income. And then any earned income you might have from working, if you're still working. And then you also have to include, believe it or not, any income you receive from any municipal bond portfolio. So while municipal bond dividends are income tax free, they are actually countable in the provisional income formula, and they're countable at 100%. Now you take all that, that's your modified adjusted gross income, your earned, unearned, and tax-free dividend income. You total that up, you count 100% of that, and then only 50% of the Social Security income. So if you're talking about a married couple filing jointly, only 50% of the Social Security, the household Social Security income, is countable when calculating somebody's provisional income value. And it's that number that you compare to these thresholds you see here on the right. So if your provisional income number is less than $32,000 and you're married filing jointly, you don't owe anything on your Social Security. And if it's less than 32, more than 32 and less than 44, then up to 50%. It's not a flat tax. Up to 50% could be taxable. And if you're over 44 as a married couple filing jointly, you have provisional income, then up to 85% could be taxable. Now, what I'm going to do here is take a minute and show you how the tax analysis breaks down for the earlies and the laters and how I arrived at that number. So the IRS has 3 tests. I'm going to focus on test 3. Test 3 says you take 50% of everything over the first threshold and 35% of everything over the second provisional income threshold. So watch how this unfolds. So if you're the earlies and you have $61,593 of Social Security income at 70 and $32,231 in an IRA distribution to close the gap, your provisional income is actually $63,28. How do we arrive there? Half of the Social Security is $37.97. 100% of the modified adjusted gross income. In this case, the only thing that qualifies as that is the IRA distribution, and the provisional income is $63,28. So on almost $94,000 of income, 63 of it's considered provisional income. Now, all that happens is you take this provisional income number, you subtract that first threshold of $32,000, and anything over that threshold is counted at 50%. You take that amount, 50% of everything over that first threshold, and that amount of your Social Security income is considered taxable. That's step 1. Step 2, provisional income again, $63,28, minus the second threshold, in this case, $44,000. Anything over the second threshold is counted at 35%. So 35% of $19,28 is $66,60. You add these two together from step A and step B, this totals the amount of your taxable Social Security income. So again, on $61,593, only $22,174 is taxable. I don't think anybody would argue that that's a real advantage from a tax management perspective. And that's if you take benefits early at 66. What if you wait till 70? Well, a couple things happen, right? You've got 32% more from Social Security, and you need that much less in fully taxable distributions from your IRA. So now Social Security is $81,302, and the distribution to close the gap is $12,522. We'll take half of $81,302, $46,51, and all of the gap income, and your provisional income number, pardon me, is $53,173. And again, it's the same routine. You take that provisional income number, it's lower in this case, first threshold, anything over the first threshold, we counted 50%. That amount we're going to include in your taxable income. Then we repeat. Step 2, $53,173, less the second threshold. Anything over that second threshold is 9173. 35% of that is 3210. So here we are. We've got 81,302 coming from Social Security, and only 13,797 of it is taxable. If all of you are like any group I've ever worked with before, for the vast majority of you, this is totally unheard of prior to tonight. But this is a tremendous planning advantage for you and the retirement income specialists that you work with, especially in the face of what I believe to be a looming tax increase at some point over the next 25 or 30 years in your retirement. And what really kind of takes this to a whole nother level is, again, not only do you have 32% more in guaranteed income thanks to DRCs and 52% less, in taxable income, but if you're a married couple filing jointly and you're both over 65 in 2020, everybody's entitled to standard deductions at a minimum. If you have itemized deductions and they surpass the standard deductions, you're more than welcome to do that too. But what I'm here to tell you is, for a married couple, both over age 60, filing jointly, the standard deduction is $27,400. So what does that mean? That means the first $27,400 of taxable income is going to be wiped out dollar for dollar by the standard deduction. And what that really means in this case is, not only are the laters going to have 32% more guaranteed income, but their plan is going to be income tax free. So we delivered the plan for $400,000 less capital. There's 32% more guaranteed income, and the income that they are receiving, the same as the earlies, almost $94,000, would be income tax free. So as we kind of bring this to a close, let's look at these from a 30,000 foot level side by side. If we look at the areas that we really want to focus on from a planning perspective, what percentage of your income goal is guaranteed if you move forward with the earlies plan? 65%, the laters 87%. The percent that's automatically adjusted for inflation without any market exposure, 65 versus 87, all attributable to the portion of your income that's delivered by Social Security. The amount of your income goal considered taxable, 58% versus 28%. And again, that zeroes out thanks to standard deductions. And lastly, look at the survivor income, almost $10,000 more a year. Critical, because if you take benefits early and you erode and exhaust your capital as a result, your surviving spouse gets stuck with a survivor benefit that's considerably lower than what it would have been had you waited to take benefits like the laters did. So here's what I want you to think about. Earlier on, I talked about how the National Institute on Retirement Security found in their research project that 77% of Americans are not on pace to meet their savings targets. And the research would suggest it's because Americans on the whole are crummy savers. What I'm here to tell you tonight is, for many of you, where you land in this equation, whether you land on the winning side being of the 23% that are fully funded, or the unfortunate side of being underfunded, really has far less to do with whether or not you've done a great job saving, and far more to do with whether or not you're working with the right people. If the people you're working with to build a retirement income plan are not versed in Social Security and do not understand the broader implications Social Security has in the overall fortification of a retirement income plan, it could cost you dearly. And to be successful in doing that, it's our position that the people have to be in a position and hold a certification that shows that they've taken the time to make themselves specialists in this area. Now, for those of you who are here tonight, we'd like to offer to you the opportunity to receive a complimentary copy of Athene Retirement Optimizer report. Pardon me. The Athene Retirement Optimizer report will provide you with a stress test of your plan, so you can tell us whatever it is you're thinking about doing, and we'll tell you whether or not the amount of capital you saved and you're on pace to save will be enough for your plan to be successful. We'll also show you other alternative Social Security optimization strategies that can change that otherwise unfavorable outcome. And maybe we can convert you from ending up in the position the earlies are in to ending up in the position the laters are in. But the only way to know is if you actually put yourself to the test and go through an Athene Retirement Optimizer analysis. And the report is very simple. Bob and Brian need about 5 to 7 pieces of information to deliver a report that culminates in this comparison page that talks about the current plan, which is your plan, the alternative plan, which is one alternative Social Security strategy, and then ultimately the optimized plan, the plan they feel is the one that's going to deliver the most favorable outcome for you. And I cannot emphasize enough that this is not something you want to try and do alone. You want to work with somebody who really understands the intricacies of Social Security and has access to this type of analytical tool. Brian and Bob are those people in your community, and they would love to have the opportunity to help you and work with you. Before we go, I just want to take a moment and ask you to complete a couple more poll questions for me before we go. I'm going to post the poll up here now and ask you to take a minute to complete that poll. It's just one question, a yes or no. It's going to take another 10 seconds or so and give everybody a chance to complete that poll. You can see some of you are still working on it. Well, thanks everybody for responding to that poll. Got a couple more for you before we go. One more. That should be up on your screen now. Okay. It's another couple of seconds here as we wrap this poll up. And I've got 2 more questions for you, and then we'll be done. Closing this poll now. Thank you very much for those that responded. One more on this topic. I'm going to close that poll here in just a moment. If anybody else needs to respond. Thank you very much for responding. Appreciate that. And then the last poll I have for you, I'd really appreciate your feedback and just giving us some indication of what you thought about tonight's webinar and whether or not I delivered on my promise to leave you far more dangerous as it relates to Social Security than you were before the webinar began. So please take a moment and complete this for me. And I want to say thank you to everybody for attending. All right. I want to say again, thank you everyone for attending tonight. Again, hopefully you found this to be a worthwhile investment of your time and you leave feeling much more empowered than you were before you arrived. I want to thank Bob Martin and Brian Tuttle of Cape Cod Financial Services for the opportunity to share this program with you. I know Brian and Bob's team will be in touch to deliver on the complimentary stress test and Social Security optimization report. So be on the lookout for a contact from them. But again, thanks everyone. Have a terrific evening, and hope to see you again on one of these future educational programs. Have a great night, everyone. Thank you.